All right, welcome once again to this class. This is Samuel Ibanda, and I'm here as your tutor. So today's class, we basically want to pick on from where we stopped last time. If you remember, we were trying to do a number on budgeting, and we had calculated different things that were required. The first thing was our sales budget, okay? Which I indicated earlier on that in most cases, the sales budget determines the rest of the budgets. We also went ahead to do the production budget as well. Then we later on went on to also look at the plant utilization budget, the direct materials budget, the direct labor budget, the fixed overhead budget, and then I think we finalized with the factory cost per unit of each product in terms of kettles. Now, there was the next part on this question, and I earlier shared the question with you. So you must have this already. Just in case you're watching this and maybe you're not part of the previous class, then you can be able to reach out to me and I'll be able to give you the question. Okay, so basically the next thing that we needed to look at, this was part 6, factory cost per unit of each product. The next thing that they were trying to ask, I think that was part 7, which is also part H, was asking for the direct materials, direct material purchases budget. Okay, it was asking for the direct material purchases budget. Okay, now similar to this, I think if you remember, there is somewhere where we had what we call the direct material usage budget. Okay, the direct material usage budget. Now, as the direct material usage budget looks at basically what kind of materials you're going to use within what you plan to, let's say, produce. Okay. And of course, right here, when it comes to, let's say, the direct material usage, as you saw, we're trying to look at how much is let's say, in production. Okay, but we had already done our production budget, which is 4,500, so parts to be able to produce this. So that was with the material usage. Now, when it comes to the material All right, sorry about that. So I was trying to say that when it comes to the direct materials budget, here basically our concentration is to determine in terms of how much do we need of materials to produce what is within the production budget. Okay. Now with the direct material purchase budget, here we are again bringing this down in terms of how much shall we have to purchase. You get it? You know, the material usage budget looks at even we are looking at it in totality. Okay, and within the usage we have, of course, we have some opening stock in raw materials that we have started with, and those will back up onto what we shall purchase, and then we shall have something also to close with. Okay, so that is all within direct material usage budget. What exactly are we going to use in production? Now, when it comes to the direct material purchase budget, here we are getting down to what exactly are we going to buy in terms of materials. Okay, how much are we going to buy in terms of materials. The other up is how much in materials are we going to use in the production. Here, how much are we going? Remember, when you're buying, you're also taking into consideration your closing stock of raw materials, because you want to remain with some stock that you can start with maybe for the next period. Okay, that is why you need to be able to distinguish the two things. Okay, yeah. So now when it comes to the direct materials budget, like I've said, here ours is to look at what shall we need in the production. Okay, what shall we need in the production in terms of materials, and then we shall also look at how much do we want to also remain with at the end of the period. Okay, because remember, what we need in production plus what we want to remain with at the end of the day. Now, that in totality gives us sort of like the materials we actually need to basically purchase. But also, it is good for us to take into consideration what kind of materials we've started with, okay? Because remember, part of what we are going to use in the production, or even part of what will remain, may include partly what we started with, okay? May include partly what we started with. But also just to understand is that now, depending on the different scenarios, okay, mainly if we are using the first in, first out, mainly ours is to first use the opening stock that is coming from the previous period, okay, before we actually jump into using what we have bought for that period, okay? So basically what I'm trying to say, when it comes to the direct materials budget, first we should look at the production requirement. How much in material do we need to have? So the production requirement. The production requirement. Okay. Now, if you're to go up, you'll be able to see when it came to the direct material usage, you saw we needed 8,500. Now, this is in terms of, remember, these are kgs. These are kgs. This is what we needed, okay? So this is our usage, and I'll try to, before that, I'll just try to make this heading down here so that it gives us a picture. So if that is material A and material B, remember what I'm trying to first look at is what exactly do I need, okay? What exactly do I need in terms of production for materials? So this is what I need. I need 8,500 kgs for material A and 28,000 for material B. So that is what I'll exactly move down. Like right there, okay? Now, once I know that I need 8,500 for material A, and then I need material B, I need 28,000. Mine is now also to look at how much do I need to close with, okay? Because how much I need to close with, remember, also needs to be purchased within this period. So I'll also look at my closing stock. My closing stock of raw materials. Now, the closing stock of raw materials, that we should be able to get it from the question. If you look at somewhere, there is a part of the question, and that is Roman numeral 3. Goes ahead to say raw materials, okay? And gives us, of course, it goes ahead to give us the closing stock in kilos at 31st March 2016. The closing stock requirements in kilos at 31st March 2016. Now, if you to remember, we are trying to look at the budget for the period ending 31st March 2016. So if in the question they are giving us closing stock requirement in kilos at 31st March 2016 to be 600 and 1,000, it's actually 600 and 1,000, means that that is what we need to close with at the end of the period, okay? The 600 and 1,000, that is what we need to close with. So ideally, if I'm to get my total of required, the total of material required, it will be basically, I'll just sum up this like that, okay? So that is what I will get. Now we shall now look at how much have we started with, like what did we start with? Remember, this is a continuous business. We have something that we started with in terms of our opening stock. So I'll go on to less my opening stock of raw materials. Opening stock of raw materials. So for the opening stock of raw materials, remember I have, if you to look at the same part, Roman numeral 2, it gives you for material A, it gives you 1,100. It gives you 1,100 as the opening stock for material A, and then it gives you 6,000 for material B. It gives you 6,000 for material B, okay? So the reason why I'm lessing is because this already exists, so I don't need to buy quantities of 1,100 and 6,000 when it comes to materials. They already exist, okay? So that is why I'll need to first determine, so what is the net? What will I exactly need, okay? And I'll call this material purchase requirement. So just, since I've already put a negative there, I'll just sum negative and positive. Give me 8,000 here, and this will give me 23,000, okay? It will give me 23,000. Now that is in terms, remember these are kgs, okay? These are actually still in kgs. So in case I need to determine in terms of value, remember this is a direct materials budget, which I need to translate in terms of value. I'll go and first include the cost per unit, okay? Now still Roman numeral number 2 on raw materials, they gave us the budgeted cost per kilo of raw material, and it is 1.5 for material A. It's 1.5 for material A, and then it is 1 for material B. It is 1.0 for material B, okay? So if I'm down to get the material purchase budget, or the direct material purchase budget, whatever you'll call it, I'll just multiply this times the cost per unit per kg to get 12,000, and I'll multiply this 23 times 1 to get that, okay? So that will be ideally my direct material purchases budget, okay? Now, the next part asked us, just to see, the next part of the question asked us to determine, the cost of goods sold budget, okay? The cost of goods sold budget. The cost of goods sold budget. So when it comes to the goods sold budget, definitely remember, we have two products. We have kettles and saucers, okay? And remember, we are working towards determining okay, towards drawing up a master budget that will include both the statement of financial position and the statement of comprehensive income. Okay, so for us to determine what we shall use within the statement of comprehensive income, we have to determine our cost of goods sold budget. Okay, we have to determine our cost of goods sold budget. Now, so we have our two products. We have kettles, and then we have the saucers. Okay, those are our two products. So we want to determine our cost of goods sold. So if you're to remember very well from our financial accounting, when it comes to cost of goods sold budget, remember the normal cost of sales. Okay, the normal cost of sales from your accounting is opening stock plus purchases less closing stock. Of course, there can also be some adjustments on purchases. Now, when it comes to manufacturing companies, okay, when it comes to manufacturing companies, where there is purchase, since we don't purchase finished goods and then resell, but we rather produce them, this is replaced by what we call the cost of production. This is replaced by what we regard as the cost of production. Okay, so what we are going to do is this, since this is a manufacturing company, this is the concept that we are going to use. Okay, we are going to first look at our opening stock and add our cost of production, and then we shall go on to less our closing stock to determine what we are regarding to as our cost of goods sold budget. Okay, yeah, so it's very important. So what we shall also do for matters of this question, remember, when it comes to inventory, okay, like I indicated, there is a part where they said, if you to look at part 2, Roman number 2 of the question, where they say that finished goods are valued on FIFO basis. Finished goods are valued on FIFO basis. Okay, finished goods are valued at FIFO basis at full production. Now, we are going to see how that applies to this question, because that's the point in time where this applies. Remember, this business has opening stock. Okay, has opening stock, or what you may call your opening inventory, and then it also has, of course, closing stock as well. Okay, so ours is to use the concept, because when it is FIFO, it means that whatever comes in, okay, because it's first in, first out. So whatever comes in first is first issued out. Okay, so that is the whole idea that we shall basically use. So let's just try to look at our opening stock. Opening stock. So from the question, if you to remember, I think they must have given us opening stock. When you look at still Roman number 2, they gave us opening stock. They gave us 900 units for kettles, and then 200 for saucers. Okay, 900 for kettles and 200 for saucers. They gave us 900. Okay, now the 900 and the 200 are in units. Okay, the 900 and 200 are in units. And remember, when we are trying to calculate the cost of goods sold budget, ours is to determine the value. Okay, ours is to determine the value. Okay, now ours is also to ask ourselves, the 900 and 200 that they have given us right there, what is basically the cost? Okay, what is basically the cost of each of those items? Okay, now Down, after giving us the opening stock, they go ahead to give us the unit cost of this opening stock. They go ahead to give us the unit cost of the opening stock, which is 20 and 28, okay? So if we need to determine how much value of stock we started with, then we can be able to determine, okay? Since they have given us information in terms of unit and they've given us in terms of units and value, I'll just try to create like maybe 3 columns for you to pick on. So if these are kettles, I want to look at units. First, you put this one down. So I want to look at units. And then I look at the unit cost. And then I'll look at the value, the overall value. Or the total amount. Okay. Let's reduce some space here. So I'll do the same thing for sources, so that we can be able to determine the unit cost as well as the number of units, okay? So what we are saying that opening stock as we were given in the question, kettles is 900, and then for saucers is 200, okay? And then we are saying that the unit cost they gave us was 20 here, and then for the unit cost when it comes to saucers is 28. So if we want to determine the total amount, it will be basically this times this, and then it will be this multiplied by 28, okay, to give us that. So these are the respective amounts, and remember that these are the amounts that we are really interested in to use because of what we are determining, okay? So after we've done that, we are saying that we add our cost of production. We add our cost of production, okay? Now, our cost of production, you have to ask yourself, what are the units? Remember, when you go back here on our production budget, we have 4,000 for kettles and 5,000 for saucers. So these are the units. So I'll put here 4,000. I'll put there 4,000. And then I'll put 5,000 right here. Okay. So what I'll do, I'll now get the unit cost. Okay. I'll get the unit cost. Now remember, we just calculated something like to do with the unit cost. Remember this factory cost per unit for each product. Okay. This is where we now come and utilize whatever we got. Okay. This is what we are going to use, the 19.63 and the 28.15. This is your factory cost per unit. So it's a unit cost that you use when it comes to your cost of production. Okay. So this is, let me just try to leave it at that. And then I'll come and pick the other 28.15. Okay. Okay. So that is what I basically have. You can just try to put any small places there. Just, and then the next I'll have, okay, since I already have, the next thing I'm now going to look at is less my closing stock. Okay, less my closing stock. Now, if you look at still the question, they have given us the preferable closing stock. Closing stock of finished products as at 31st March 2016 on notice Roman numeral number 2, we have 400. Okay, we have 400 for kettles, and then they have given us the other is 1,200. Okay, is 1,200. So that is what we basically do have. Now, yours is to ask yourself, so what will be the value of closing stock? When you look at the question, Roman number 2, when it came to opening stock, they actually gave us the unit cost of this opening stock. But when it comes to closing stock of finished products, they have actually not given us the value of that stock. Now, also from your observation here, you should be able to see that we have different stock at different rates. Okay, we have different stock at different rates. Let me just try to increase this so that you're able to see that these are different. So you saw that we started with stock of 20 and 28, and now we are in calculating our cost, factory cost, unit cost of production. We're able to get 19.63 and 28 point. So there's a slight difference when it comes to this kind of value of stock. Now yours is to question yourself, so what will be the value of my closing stock? Okay, now this is where what the concept of FIFO comes in. This is where the concept of FIFO comes in, and FIFO says that remember, we're trying to look at first in, first out. So this would mean that we will make the assumption that actually all that we started with was sold. Okay, with the concept of FIFO, we shall assume that all the stock that was valued at 20 and 28 that we started with, all this was sold off, because this is first in, first out. Okay, and because when you look at this, we started with 900, we made 4,000, and we are closing with 400. So ideally, the 400 is within the 4,000. Okay, so ideally, if we are using the first in, first out, it means that we are going to use 19.63 as our unit rate here. And why we are using 19.63 is because we assume that the opening stock that was valued at 20 and then 28, when it comes for saucers, all of it was sold off. Okay, so that is why when it comes here, I'll basically use the 19.63 as the unit cost for inventory. Okay, for my closing stock. So if I'm to get the value, this will be 400 times 20 to get me that value. And then when it comes to right here, I'll still use 28.15. Okay, 28.15, like that. Okay, that is what I'll do have. So given that information, and if once I do have that, what I'll now proceed to do is to now determine my cost of sales. Okay, determine my cost of sales. Remember, my cost of sales is opening stock plus cost of production less closing stock. Okay, and basically, since what I'm interested in, okay, I'm interested in the units. I can try to just get the units, but the units may not even matter. Let me just try to go to the value, because this is cost of sales. Okay, so it's in terms of value. So I'm going to get 18 plus my cost of production, and then I'll less my closing stock. Okay, so this will give me 88,650. 88,650. Then I'll move here. The same thing, I'll get that. I'll add that, and then I'll less 33,780 to give me 112,570. Okay, so this will be basically what I'll regard to as my cost of goods sold budget. As simple as that. Okay, as simple as that. Now, still as part of the question, they also asked us to get what they call the cash budget. Okay, they asked us to get the cash budget. Just call this part 9. Asked us to get the cash budget. Now, if you're part of the earlier class, I explained what a cash budget is. And I said basically cash budget is trying to look at your cash inflow and then the cash outflow, okay? It's basically looking at the cash inflow and the cash outflow. Now, from the question, when you look at, they gave us part, this is I think part 8 of the question, which they called the budgeted cash flows for the business. They are as follows. They gave us receipts from customers, and then they also gave us payments, okay? So that should be our beginning part because they already gave us the cash flow. So that is our beginning part. And then we shall try to include any other information that maybe we've come across along the way, okay? But that should be able to give us the picture. So they gave us the receipts from customers, I think 70, 100 for quarter 3, and then 40,000 for quarter 4. And then they gave us the respective payments as per that, okay? So we are going to use the same information to start. Now, the information they gave us was in terms of quarters. So we shall also adopt quarters, okay? So we have quarter 1, then we have quarter 2, have quarter 3, and then we have our quarter 4. We have our quarter 4, okay? So we have receipts. Remember, a cash budget will always start with receipts because this is like your cash inflow, okay? It's from your cash inflow that you come and subtract any cash outflow, okay? So receipts. The receipts we have. So quarter 1, when you look at our question, they gave us 70,000. Quarter 2 is 100,000. And this is also 100,000. And then quarter 4 is 40,000. Quarter 4 is 40,000, okay? So yours is to ask yourself from the additional information. Of course, we can also have the total here. From the additional information, we didn't get to see any other receipt that the business expects. Like I said, another receipts could be, let's say, commission, could also be dividends, could be interest, okay? But we didn't really get that. So our assumption is maybe this is all embedded within there, within the receipts, okay? So when you try to get the summation of this, this gives you 310, okay? So after you've looked at your receipts, yours is to now move to your payments. Yours is to move to your payments. So part of the payments, we have materials. We have wages. Then we have other costs and expenses. Have other costs and expenses, okay? So when it comes to quarter 1, for materials, this is 7,000. Part 2 of this quarter 2 is 99,000. Quarter 3 is 10,000. And then quarter 4 is actually 5,000, okay? That is basically what we have. And then Q1, this is 33,000. This is 20,000. This is 11,000. And Q4 here is 15,000. Okay. And then this is 10,000. This is 100,000. This is 205,000. This is just basically copy and paste from the information I've been given. I'm not really calculating this, so you shouldn't really disturb your mind. Okay. If I'm just to get the total of each of these, 31, like that. Okay. So I can also get the total payments, like the total of each quarter, under each quarter. This summed up will be 50K, 129, 226, 25,000. Okay. You can also try to get the total of each of all these, standing at 430. Okay. Now that is what I basically do have. So mine is to look at these payments vis-a-vis my receipts. Okay. Okay. So right here, I'll get the difference. My receipts. There's payments, which will be the 70 minus 50. Okay, to give me 20. Let me just try to cascade this down. So it gives me, as you can see, Q2 gives me a negative. 100 minus 129 gives me negative this. The same thing with Q3 also gives me a negative as well. Okay. And remember, these are the prompts that I told you that such a document can help you with. You can be able to determine in how much in how much will you need to cater in terms of your liquidity. Okay, this is a point in time where you may also think of let's say maybe borrowing somewhere somehow. Okay, but before we make that decision, ours is to first look at the opening balance. Remember, these are cash flow and this is cash. And as a business, you at least always have something that you start with, which is your opening balance. Okay. So for Q1, we have to look at what cash did we start with. Okay. What is our opening cash? And how to determine this? If you to go back to our question, okay. If you to go back to our question, there is where we have our trial balance. Okay, we have a trial balance here, and it has land and building, it has plant and machinery, those are fixed assets, and then it has the current assets. Remember, this balance sheet is at 1st April 2015. Okay, this balance sheet is at 1st April 2015. So from the trial balance, from the balance sheet, current assets, we have raw materials, and then we have finished goods, and then we have debtors, and then we have our cash. Okay, we have our cash. Now, when you look at our cash shows 4,100. Our cash shows 4,100. We don't have basically current liabilities. We only have creditors. We don't have anything like, let's say, bank overdraft and so on. Okay, so what I'll do is my opening balance, I'll use 4,100. Okay, right there, because that is what we started with. And then you have your closing balance right here. So after you've taken into consideration what you started with, plus what exists in terms of, let's say, from your quarter, the net of your receipts and payments, this should be able to give you your balance, okay? Your closing balance. This will be the closing balance you close with to move to the next quarter, okay? And remember, what is the closing balance right here should be an opening balance in this place, okay? So this will be the opening balance right here, like that. So when you get, again, you get the summation, you add the receipts less payments and add the opening balance, should be able to determine your 4,900, okay? So like that. So this will also now be here, okay? So you still get a summation of this, like that. So you proceed. This will be right here. Okay. So this is what you have now. As you can see, you're seeing that in quarter 2, based on our cash budget, we actually estimate that we shall be in kind of a deficit, okay, in our cash. This would now prompt management to plan in advance, let's say take credit during this time, okay? The same thing with quarter 3 and the same thing with quarter 4. So ideally, management should look at these deficits, these respective deficits as they are, and then determine how much money they will need to, let's say, borrow, okay, to be able to cover up this deficit. So it's important. It is important. So that is what you basically need to know. So that is what we have with our cash budget. This question really requires to interpret, but you can just leave a small interpretation just in case. This is just for our learning purposes, okay? So part of the next question was asking us to determine a budgeted profit and loss, and then a balance sheet, okay? So this is, I'll call this part 10 of the question. Part 10 of the question asks us to draw up our budgeted profit and loss account for the year to 31st March 2016, okay? Now, the budgeted profit and loss, just like the cash budget app, is part of our master budget, okay? So it's important. And after this, we are going to draw up our budgeted statement of financial position. I believe you know why we are starting with the profit and loss, because we also want to determine our budgeted net profit from this, okay? Yeah. And you know, when it comes to the P&L, the first thing we look at is sales, okay? What is our sales? Now, remember, we had what we regarded to as our sales budget. You see what we had? We had kettles, we had 144, and then we had 176 for saucers. So based on what we have, I'll just try to put the headings as well, just to show the breakdown. So if I have my kettle and saucers, if I just want to distinguish that, I'll just try to bring this 144 and 176 as part of my sales budget. So right there, that is what I do have. I can get my total. Remember, this is a P&L, so basically the total is very important for me. So total of this is 320, okay? So after sales, I'll less my cost of sales, okay? I'll less my cost of sales. Now, if you remember, we just calculated our cost of goods sold right here. And this was the reason why we calculated. We got 88 when it comes to kettles, and then we got saucers, we got 112, 570. So I'll just pick the 88, 650, include it there. And then I'll also go back and also pick the other, which is the cost of goods sold budget for saucers, and include it there, okay? So basically here, you're just trying to copy and paste from the read information you already have, okay? So you can also get the total right there, okay? So that is what I do have. I have my sales already, I have my cost of sales. So that means I can determine my gross profit or loss, depending, okay? So right here, when I try to get the difference, of this, gets me 521,220, okay? 521,220. Oh, sorry, the gross profit is less, sorry, it is this less than this, not the summation, so it gives me 118,780, okay? So that is my gross profit. And then the next is our less other operating expenses. Other operating expenses. Now, when you look at our question, they gave us other expenses were the production overheads, and then we also had the selling and administration, okay? Now, the production overheads are already embedded within the cost of sales, okay? They are embedded within the cost of sales. So the fact that they're embedded within, we shall not consider them in other operating. So basically, under other operating expenses, what we are going to consider are our selling and administration costs. Selling and administration costs or expenses. Okay, selling and administration expenses. And if you look at the question, this is Roman number, but this is 7. They gave us this value to be 30,400. Okay, they gave us 30,400. So what this would mean is that we don't have any other expenses that we have, okay, other than this. So that means that this will give us our net profit, since the gross profit is higher than the other expenses. 118 minus that, giving us 88,380, okay? 88,380. That is what we basically do have. And then part of the question required us to determine the budgeted balance sheet, okay? So I'll just call it this part 11 and call it the budgeted balance sheet, okay? And this will be as at 31st March 2016. Can even give it a title. This is Tamale. Tamale Limited is budgeted balance sheet as at that date, okay? Now, if you to look at our question from the beginning, they actually gave us a balance sheet that was starting. They gave us Tamale Limited balance sheet as at first, okay? So that is one of the first things that we are going to borrow to use, okay? And that's it's a similar format that we shall basically use, as you can see. Okay. So when it comes to balance sheet, definitely we can have the amounts. Okay. We can have the amounts. And remember, this is UJEX. So we can have those amounts. I can create 3 columns right there. And then I can have, I'm going to have my fixed assets. Okay, I'm going to have my fixed assets. And under my fixed assets, as you can see from our question, I'm now looking at, as I prepare this, I'm trying to look at the balance sheet I started with the additional information. Okay. Now, if you have to look at the starting point, we had land and building. Land and building. You know very well that when we are trying to calculate fixed assets, we have what we call the cost, okay? And then we have the accumulated depreciation. And then we have the net book value. Okay. So land and building, you know, land doesn't depreciate. And from the question, land and building, they gave us 187, okay? They gave us 187 in the previous balance sheet. But then there was also another additional information. There was another additional information which said that machinery is to be, okay, this Roman numeral 6, okay, which says that land worth 180 is to be acquired in December 2015, okay? So by 31st March of course, we have already passed by December 2015. So in addition to what the 187 that we started with, okay? In addition to the 187 we started with, 187,000, we also have what we are buying, okay? What we are buying, which is 180. We are buying worth 180, okay? As you can see. Now, yours is to ask yourself, are we selling? Do we have anything? This. So this is land and building. Sorry, land and building is not 187 is actually for plant and machinery. Okay, sorry. So land and building is 45, which is the beginning, 45,000 plus 180 to give us the 225. There is no depreciation here, and it actually gets to that. So it's a plant and machinery where we're going to use the 187, plant and machinery. Plant and machinery. So for plant and machinery, remember we started with 187. Okay, that is what we started with. Now ours is to find out any addition. Remember they said that a machine costing, okay, a company, okay, machine costing UJEX 20,000 is to be installed on 1st October 2015, okay? So they are basically going to install a new machine worth 20,000, okay? So I'm going to add 20,000 here when it comes to cost. So cost-wise, we are going to add a new machine worth 20,000. Okay. Now, in the same way, if you have, let's say, you have 207, yours is to ask the depreciation. What will be the depreciation? Now, if you're to remember, I think we calculated depreciation somewhere. I think that was on overhead budget. I don't know where we did from. It was right here. Remember, we said depreciation existing. We depreciated, we got 500, and then for the, okay, this was for the existing, just to confirm. Okay, this was existing plant and equipment. Okay, this was for existing, and then we also had, and it was just a breakdown between machinery and assembling. That is why we did it like this, because of I think for machinery it was straight line, and then for assembling it was basically reducing balance. The same thing happened with with what we purchased. We purchased a component for basically for machining. Okay, so when we are taking it to the balance sheet, we shall not really do this breakdown. So mine is just to add this respective depreciation, the 500 plus the 850 plus the 500, okay, to get me 9850. Okay, so it gets me 9850, which I'm going to be able to use the other side. Let me just try to see if they gave us any. So if you're to look at, yes, if you're to look at the question, they actually gave us a beginning accumulated. So this is this 9850 is the depreciation for the year, okay? But when you look at the question, they gave us the accumulated depreciation to the extent of 750, okay? They gave us, it's actually 75. They gave us this depreciation, accumulated depreciation of 75. So mine is to get the summation of the two, okay, to determine basically what I'll have the other side. So I have over 84,850, okay? So I have 84,850. Like that. So that is what basically I do have, okay? 84,850. And then once I do have that, mine is now to go to calculate my current assets, since I don't have any other machine. So still current assets, I'm going to borrow a leaf from what I have in the beginning trial balance. But since this is now, since I'm now into closing another period, what I'm going to do, I'm going to, of course, the breakdown, the breakdown of what I'll have raw materials, and I'm picking this from the balance sheet they have given us. So I'll have something on raw materials, I'll have something on finished goods, and then I'll have something on debtors, and then I'll also have something on, let's say, cash, okay? I'll have something on cash. So what I'm going to do now, I'm going to look at raw materials. Now the raw materials, the value I'm going to use here is the closing raw material, okay? Is the closing raw materials that I was given. Now, when you try to look at the question, we have the closing stock. We have the closing stock requirements in kilos as at 31st March 26. This is Roman numeral number 3. Okay. So they have given us 600 for material A and material B. They have given us 1,000. Okay. And then they have also given us how much that relates. Okay, in terms of value, they have given us 1.5 and 1.0. So I can rather calculate from there, or what I can basically do is go back to the question and see where I actually calculated my closing stock for the materials. Okay, right here. Did I calculate it? I think I didn't. I have not calculated it anywhere. Just to confirm, I didn't calculate it anywhere. So you can basically calculate it, okay? Because okay, you can try to do a working. Maybe let me just try to put here. So for raw materials, if these are, remember this is material A and this is material B, okay? This is just a working. So for material A, my closing stock is 100, and then for material B is 1,000. And in terms of rates, this material A is 1.5, and this is 1.0. Okay. Remember, all I want to determine is the value of my closing stock of raw materials, because that is what appears within my balance sheet. Okay. That is what appears within my balance sheet. So this is the value. Okay. That is the value, the 9,000, the 900 and 1,000. And if I'm to get the total of this will get me to 1,900. So within my balance sheet, when it comes to raw materials, I'll put that value. I'll even bring it here to the last point, which is 1,900. Now I also move to the next finished goods. We just confirm that I didn't calculate finished goods anywhere, but I think I calculated them. Closing stock of finished goods. Remember, when we're calculating our goods cost of goods sold budget, our closing stock, yes, the 400 and 1,200 was given to us, but they didn't give us the value. Okay, so we use the FIFO method to determine these respective values. So mine is to just get the total of these two things. Okay, right here, the total of kettles and saucers in terms of value of closing stock, which is 41,630. 41,630. So I don't have to recalculate, but you can also do recalculate it. You can use the table here and calculate it. Okay. But since I already used it somewhere, myself, I will not calculate it. So I'll include it there. Okay. So the next is now to look at the debtors. Okay. Next, I'll look at the debtors. Now, from what we see from our question, we started with debtors of worth 9. This was 19,500. Okay. So for the debtors, I'm going to calculate it. Maybe can call this working one. I want to show you how I'm going to get my debtors. Okay. So debtors, I have my opening balance. Debtors are basically receivables. Okay. So opening balance is worth the 9,500. From where? Right from what? Right from our balance sheet that they have provided to us. Okay. Now, yours is also to understand that when it comes to the debtors come into place because of what? Debtors come into place because of sales, okay? So mine is to look at how much did I sell, okay? And how much did I receive? So I look at my sales, okay? So from our sales budget, if you remember, our sales right here, it was 320, okay? So our sales was 320. So after considering my sales, I now come and less receipts. What have I received during the period, okay? Now the receipts, I get those from my cash budget. So you come to your cash budget and see how much you receive in receipts. It's 310. So I'll come and put it right there, okay? So the debtors that I started with, okay, plus 320, of course, 320 would increase my debtors since I've sold, okay? And then anything that I receive reduces that balance, the 310. That is why I'll get my debtors on, okay, debtors carried forward basically will be the 19 plus 320 minus the 310, okay, to get 29,500. So this will be 29,500. So you've seen I've tried to use the beginning debtors that are now our balance sheet, okay, on the first page, okay. Then the next one is now I'm going to look at my cash, okay. Now cash, as you saw, the cash, we've done a cash budget. So a cash budget should be able to give us how much cash we have, okay. So from your cash budget here, you realize that we actually closed with, our closing balance was 115,900, and it was a negative. So cash, we basically don't have cash, but we rather have an overdraft, okay. So here cash will be 0, but then when we come to our current liabilities, which I'm going to do immediately, let me just get the total of this. Okay, I can get the total of all the assets to be at 400, 420, 180. So when it comes to my, I'll move to, remember this is total assets. This is total assets. So the next part is equity and liabilities. Okay. So under my equity and liabilities, right there, I'm going to start with, let me just see from my, the balance sheet I've been given here, how they, so I'm going to start with my current liabilities, okay? I'll start with all liabilities. Liabilities. But from the question, I see I don't have any long-term liabilities, so I have only current liabilities. So under current liabilities, in the question, I was given creditors, okay? I have creditors. Now creditors, I also have to calculate it. But before that, I have a bank overdraft that has come up. Bank or overdraft. Okay. This bank overdraft is what is within here. This 115,900, okay, is the bank overdraft. So I'll put it here and then I'll calculate the creditors. So the creditors, I'm just going to calculate them the way I did for debtors, okay? So creditors, my next working here, working 3. Now, remember the creditors, this is money that you're supposed to pay, okay? For debtors, it was money you receive, okay? So anything that brings takes away money in terms of paying creditors, then that is recorded right there. Okay, so I'm going to have my opening balance for creditors, opening balance for creditors. From the balance sheet, my opening balance is 6,800. This is what I started with at 1st April 2015. Okay, I started with 6,800. So now mine is to ask myself, what are some of those other things did I either sell? Okay, what are some of those things, not I sold, but what did I purchase and I needed to pay? Okay, and then how much did I pay? Okay, how much did I purchase and how much did I basically pay? Okay, now if you look at this very critically, we have different things that we actually bought during the period. Okay, and remember, we have materials. Okay, so we have materials. We are going to look at things we bought. Okay, materials purchased, and remember, materials purchased, we have what we call, okay, either material purchased or material to be purchased, because this is a budget. Okay, so we have what we call the material purchase budget. You see this, the material purchase budget. In total, we plan to purchase over 35. So I'll come and put the material purchase budget there. Okay, remember, I'm also going to remove any payments that I actually made during the period. Okay, and those I'm going to get from the cash budget, but let me first look at the things I bought. Okay, so apart from materials, of course, definitely I also have let me first look at labor as well. Let me look at labor. I also of course, the labor budget is also part of what I pay. They're also part of my creditors. So I'll come and look at my labor budget. It was 110,400. Okay, so I'll include it there. Okay, so first looking at the direct materials and labor. Now, apart from that, mine is also to look at the production overheads. Okay, mine is to look at the production overheads. Now, remember, we also have a production overhead budget. But this production overhead has depreciation within. Okay, and remember, we don't pay for depreciation. I hope you know that. We basically don't pay for depreciation. So what I'm going to only take is this, the production over the factory overheads before depreciation, whose total, let me just get the total of this. This has actually been even given in the question. When you look at Roman numeral, I think 6. Okay, so I'm going to basically consider what the overheads before depreciation, production overheads. $58,150. Okay, that is another. Now the next that I'm also going to look at is I've looked at my All right. Sorry, internet had pushed me out, but I was trying to calculate my creditors balance, and I'd looked at the opening balance. I'd tried to add the respective labor and try to add also the production overheads. So the next I was talking about is land. That from the question, if you look at the question, they actually bought they bought some land on Roman numeral number 2, where they say that okay, one, even before land we have machinery. Okay, we have the machinery. So we have land and machinery. And for machinery, they are saying, okay, the whole statement is saying a machine costing 20,000 is to be installed on 1st October 2015. So I'm going to first consider the machinery here. And mine is now to also look at, they're saying land at 10,000 cost, okay? No, sorry. They already have a machinery installed worth 10,000. Land 180,000 is to be acquired. So land is 180,000 that is to be acquired. All that would affect my creditors balance, okay? The 180,000. So once I'm done with that, mine is also to look at my selling and administration expenses. Selling and administration expenses. Those were also, they didn't indicate to me that they were paid immediately. And I've been given those to be 30,400, okay? I've been given to be 30,400. So mine is also to look at and see, do I have any other expense that I actually paid, okay? What did I have any other expense that I actually, let's say, got that I need to include as well? Because at least I've included the selling and administration. I've included the materials, okay? I've included the production overheads. I've included labor. I've included materials. I've included the machine purchase, the land purchase. So that should be able to be enough. So all this, if I'm to get the summation of this will give me, of course, it's like the opening balance of creditors plus whatever you've purchased. So gives us our creditors that we're starting at that. Then ours is to now less the payments, okay? Less payments made. Now, payments made, those we shall go to our cash budget, which we drew here. As you can see, our total payments were standing at 430, okay? So I'll pick my 430 from my cash budget for payments and bring it right here. So as you can see, we had 440, 750, and our payments are worth this, okay? So if I'm to get the closing balance of my creditors, the closing creditors balance, it will be basically the total, the 440, 750, and less the 430, which gets me to 10,750. So this is what I'll include as my creditors balance under my balance sheet. Just remove a negative on this one, okay? Like that. Remember, we didn't have any long-term liability. So I'll just move to now to equity. I'll move to equity. So from the question, when you look at your beginning balance sheet, sorry, we had share capital. We had share capital. Our share capital is is 150. Now, share capital during the period didn't change, okay? If they had issued any new share capital, or okay, if they had planned to share, to get any new share capital, then we would include it right there, okay? But we don't have that there. Then the other under equity is our retained earnings, okay? Our retained earnings. Now, retained earnings, we shall calculate, we shall look at the retained earnings we started with. We started with 55 in the balance sheet that we started with, 55 to 50. And then we shall go ahead to add, the profits we got from up here, this 88,380, okay? Which gives us 143, gives us 143,630, okay? Yeah. Now we shall have our total equity and liabilities. Okay. Total equity and liabilities. This will just add all this to give us 42,180. Okay. There is a small difference between those values, and the reason why we have some difference between these values was because this question had a slight error, like I earlier indicated when we were trying to start on it. Okay, when you look at if you have the ISPAL book, you should agree with me that the opening balance right here, instead of using 4,100, they actually used 4,300. Okay, they used 4,300. One of the other differences they also had was to do with the asset that was bought. Okay, the asset that was bought, which they indicated here. Actually, it was not asset. It was about the land. No, machinery that existed. They had 100. They considered 100,000, and in the question it has 10,000. Okay, so that was just the difference. But ours is to get the principal at the end of the day within the question. Okay, the principal within the question. I hope we've been able to. So basically, the balance sheet, your budgeted balance sheet, and the budgeted profit and loss, and then the cash budget would form your master budget. Okay, would form your. So when they ask you draw up a master budget, that is what the examiner will be looking out for. Okay, so it's important for you to understand those terms. Okay. Yeah. So you have notes, and there are some examples in the notes, which I say that you get some time and try out. And in case you have any challenge, please revert. Okay. In case you have any challenge, please revert accordingly, so that we can be able to go through that. Important for us. Okay. Yeah. So we have about 3 minutes, but I wanted to start on it, on something new for this class. Of course, I usually interest myself that at least every day we should be able to look at something new. Okay. So basically, today this was my interest. I wanted us to look at performance measurements. Okay. I wanted us to look at performance measurements. Now, if you look at our syllabus, performance measurement here, Here they may call it, they call it division performance evaluation, okay? This is for just cross-check with your, it is the division performance evaluation, okay? That is basically what is right there. The divisional performance evaluation. As you can see, they are bringing in the word division, okay? And you know very well that businesses these days work in divisions. They're either departments, they're either branches, they're either subsidiaries, and so on, okay? But the reason why I've called this whole topic performance measurement basically is because we want to not only look at divisionalized companies, but also be able to look at companies that are basically standalone, okay? That's why we are trying to look at this. So basically in this chapter, ours is to understand how different organizations measure performance, okay? How different organizations measure performance and why that is important to you as a management accountant, okay? Yeah. Now, before we get to understand more about performance measurement, ours is to understand the key pillars of the organization. Basically, what does the organization stand for, okay? And in understanding that, this should be able to help us. The mission statement. What is the mission of the organization, okay? Because all this feed into performance. It is after we've understood the mission of the organization that we can say the organization has performed rightly, okay? So based on the definition here, the mission statement is basically expressing your overall purpose, okay, as an organization. And it includes purpose, why you exist as a company. It goes ahead to look at the strategy in terms of the range of activities which you intend to complete and how you intend to compete as well, okay, your strategy. And then also policies and standards. Basically here we're trying to look at how do you run? What are the guidelines that guide your staff in carrying out the strategy, okay? And then the other are values, which are moral and beliefs, principles, which foster your company's culture, okay? So we have an example here for McDonald's, which says McDonald's vision is to be the world's best quick service restaurant experience, okay? Being the best means providing outstanding quality, service, cleanliness, and value so that we make every customer in every restaurant smile. That is their vision, okay? So that's an example of a vision statement. And then of course we have the goals and objectives, which you must be aware now. And when it comes to goals, for example, the goals come, of course, the goals come from the mission, okay? It's basically a breakdown of your mission. Once you have your mission, then you break down in terms of your goals and objectives, okay? So an example of a goal, as we can see, can be, for example, to improve profits, okay? It can be, for example, to improve profits. And then the other, of course, for us to get down to an objective, remember where we now bring in the thing of SMART being looking at things to do with specific, measurable, attainable, realistic, okay, timeliness. We now get down to improve it and say to increase the profit by 20% within 2 years. So that should be able to give you the distinguish, how to distinguish the two, the goal and the objective, okay? So we have what we are regarding to also the critical success factors and key performance indicators. Basically, we are trying to see what do we look at to say this company has actually performed well, okay? What do we look at to say that this company has performed well, okay? So here, of course, based on the organization and based on what the organization regards itself as its own purpose, that will give us guidance to understand whether the organization has performed well or not. For example, I think we saw part of McDonald's factor, part of its vision was to ensure that they're offering a quality service, okay? The quality restaurant products. But then they're also trying to look at maybe things to do with, for example, the speed of service, okay? So when looking at the key performance indicators, sometimes people call them the KPIs, okay? So McDonald's may decide, of course, to measure the quality, because the success factor is the quality. Now ours is how shall we measure quality, okay? And we are saying that McDonald's can say do a ranking of 1 to 5, okay? And give the customers to decide, maybe after they have served them food, to decide on average what has been the quality of the food you've taken, okay? And maybe the customer may rank of, let's say, 1 to 5. And then when it comes to, let's say, maybe speed of service, they can also determine how long did it take you to be served. And somebody can say either 5 minutes or 10 minutes or 20 minutes. So from there, McDonald's, so the key performance indicators were in terms of the measures, like the rating of 1 to 5, and then the one of minutes is able to, those are like key performance indicators. So McDonald's can say ours is, of course, quality. And by quality means that we should achieve 4 and above customer satisfaction, okay? And when it comes to the time, McDonald's can go ahead and set a key performance indicator of saying that on average, each customer should be served within 5 minutes, okay? And that is its key performance indicator. Remember, we're trying to look at the performance measurement overview, okay? Which is also part of the divisional performance evaluation. So all this will guide. So any branch that achieves that is looked at as a branch that has actually performed better than the other, or that has been able to get the exact results, okay? So here we are getting down into, we are saying that it's important that the company has a range of KPIs, okay? Both financial and then, of course, the non-financial, or either maybe quantitative and non-quantitative or qualitative, okay? And of course, this is very key because companies do exist. For example, McDonald's, in addition to giving you a quality service and giving you these commodities to be given to you very, let's say, at a faster speed, and also to give you a better experience from the restaurant products, that should not be compromised. That should not compromise the financial return they are making as a business, okay? And that is why these KPIs should, and that's where I think if you must have heard about the balance scorecard. The balance scorecard is one of the things that we shall be looking at. The balance scorecard is one of those tools that looks at both the qualitative and the quantitative factors, okay? It looks at the two things. So it's important for you to understand those, that if you're setting KPIs, then they should actually be both financial and non-financial. So in basically, in simple terms, performance measurement is a process of assessing whether the division managers achieve the desired objectives. And basically here, we're trying to see, as we saw, one of the objectives was to increase profits by 20% within 2 years. So have our managers achieved that objective, okay? And of course, we also need to understand, of course, in the same way, in achieving the objective, then we set the key performance indicators, and we also have the critical success factors, okay? Yeah, so it's good for you. So management of any divisionalized company has to set different KPIs, the key performance indicators and critical success factors, to enable it to carry out the performance measurement on, let's say, on a monthly basis, or it's a quarterly basis, or a weekly basis, depending, or annual basis, okay? So, and the reason why this happens is because management that is running divisionalized companies, they want to offer a higher degree of autonomy, okay, where different branches are able to run the show, okay, and just like the way you see banks run, where different branches are able to make to get their customers, serve them well, and then at the end of the day, management wants to use performance indicators or performance measurement tools to determine which branch is performing better than the other, okay, and maybe which branch is meeting the KPIs, the key performance indicators, okay. So that is what happens. But in the same way, one of the things that we shall also be trying to understand here is that these whatever the objectives of each branch that each branch is achieving, this should form into the overall objective, okay? And we that term we call it the goal congruency, okay? Goal congruency is where every division is building its success around achieving the overall objective of the overall organization, okay? So as they pursue their individual indicators, this should not compromise on the overall objective, okay? So if, for example, our objective as a company is to increase profits, again, we should be able to see each branch towards the same thing, okay? We should be able to see each branch go to the same thing. So also physically to also understand, I think we talked of responsibility centers at some point in time. Branches or divisions can either be cost centers, and by cost centers means that in that case, such divisions, we only look at costs, okay? It could be maybe a revenue center, and where such that responsibility center, basically we evaluate that branch on revenue, okay? It means that costs are not part of their evaluation, and that's why we're calling it a revenue center. It can also be a profit center. A profit center is where a branch is responsible for both the revenue and expenses, okay? Yeah. And then investment center is where a given branch is given autonomy on to bring in new products, okay, to innovate any new products and to also make other investment decisions, okay? Yeah. So of course, the reason why we are bringing the responsibility centers at a point in time like this is because once we are doing the evaluation, you can't evaluate a branch that is, let's say, you're taking into consideration to be a cost center, meaning you're only looking at costs, but then you're now evaluating them on revenue, okay? So you should basically know, is this a revenue center? Is this a cost center? Is this a profit center? Is it an investment center? So that even your parameters of evaluation are also aligned. So you know that I'm evaluating this branch from the investment center perspective because it's actually an investment center, okay? So if it's, for example, a revenue center, means that anything to do with costs should not be part of the evaluation. So it's important for us to pick that up. And then we have the measures of performance methods. Like we said we should basically look at the financial and financial, and then get a combination of the two, okay? So the performance measures to be chosen, we have some key principles. One, they should measure the effectiveness of all processes, including products and services that have reached the final customer, okay? And then the others, you should measure efficiency in terms of resource utilization. They should comprise of an appropriate mix of both qualitative and quantitative, which is both financial and non-financial. And then should also have a long-term and short-term perspective. And then should also be flexible and adaptable to the changing business environment. A time like this, when we're in times of COVID, where businesses have dropped in sales, and businesses have also changing ways of working, these indicators should be able to take into consideration this way of things, okay? So it's important for us to understand. So we now get into the gist of the whole thing. which is our divisional financial performance measures, okay? The divisional performance measures. And what we are trying to look at, like I said, these are like branches, okay? So we are trying to see what are the financial performance measures to divisions, okay? Or what other people can call the branches, okay? So now, I already explained when it came to goal congruency that every time you set, for example, some measures, you find that sometimes some branches are actually pursuing an alternative direction compared to the overall goal of the objective. So every time you're setting a financial measure or a non-financial, yours is to make sure that you're achieving goal congruence, okay? So just maybe also to know, of course, the visualization as from a definition perspective is where, of course, managers of different divisions are given a degree of autonomy over decision making, okay? Basically, like, so it's basically giving authority to the managers, bringing it's some other people may, yeah, divisionalization, okay? So basically from I've talked about the revenue structures, where I say that when it comes to cost centers, ours is to look at only costs, okay? So it means that if a division is referred to as a cost center, the manager is only responsible for costs. And we are saying that the typical financial measurement indicator or performance measure should basically be on standard costing variance, the standard costing variance. And what this means is that if, for example, we are saying a branch is a cost center, if we are trying to look at maybe the salary cost, ours is to look at what is the standard salary cost, basically what would be the typical salary cost for that branch and how much have they spent. Then from there, we should be able to get our standard cost variance, the difference between what they have spent vis-a-vis what should be the standard cost, which gives you a standard costing variance. Similar to profit center. Now, when it comes to profit center, this is where we are saying that the manager is responsible for both revenue and costs. And here we are trying to say that the typical financial measure here should be the controllable profit. Now, the word controllable here means that we are only looking at the revenues that the manager has control over, and then we're also trying to look at the costs that manager has control over. Now, revenues might come really very easy because any revenue that a manager has control over is revenue that maybe has been generated within the branch, okay? Of course, they could have other kind of revenues. Could be internal revenues, maybe internal revenues that are fostered by the company to sell internally. So one branch can sell to another branch, okay? And maybe that could be a policy within. So those could be revenues that this manager doesn't have control over. But then we can also have, when it comes to costs, manager can have different costs that they have, let's say, decisions over. And then they also can have costs that they don't have decisions on, okay? For example, if it comes a branch, a manager, if it's a bank branch, those that have worked with banks will attest to this. When it comes to branch, you may find that this manager doesn't have control over hiring, okay? Most of the staff are hired by the head office. So all the costs of this staff are not within the manager's control. So the manager's performance is not measured on this. And then the other, you could look at things like, for example, the head office cost charge. Now, there are costs that are incurred at the head office, but these costs are spread across the different branches. Now, any manager who is part of any organization, or for a given branch, you find that you don't have control over the head office costs, okay? Because I'll give you an example. If the head office has rent, in most cases, the head office maybe will not be running the normal selling. It's basically a control office. So it means that the cost, its cost is distributed. Maybe they say 10% on every branch. Now the manager has no control over either increase or decrease in that amount. Okay, so that is like a cost that is outside their controllable costs. So when we are determining our controllable profit, ours is to determine what are some of those revenues we have control over, and what are some of those expenses we don't. We also have control. The difference between two should be able to give us our controllable profit. As we proceed, we shall also learn something to do with traceable profits. And traceable profits, this is from division performance. Okay, so we shall basically see how that works. Of course, an investment center, this is usually where a branch is in charge of its costs, revenues, and then of course assets. Okay, why we call it an investment center is because the manager or the division have autonomy over purchase of fixed assets. They basically have autonomy over investment in addition to the costs and the revenues. Okay, now when it comes to an investment center, when we are evaluating managers, ours is to look at what we are regarding to as the return on investment and residual income. Okay, we are trying to look at the return on investment and residual income, and we are saying that these two structures are often referred to as, of course, divisions, and where divisionalization refers to the delegation of the profit-making responsibility. Okay, so basically that. What should make a good measure for a manager? One, should be able something that provides an incentive to the divisional manager to make decisions which are in the best interest of the company. Remember our word of goal congruence. Goal congruence will be a common term all across this topic, because it's one of the challenges, by the way, with performance measurement. Okay, usually you find that since the manager knows that this is my target profit, they will not want to mind about how other branches are performing. Theirs is to keep pushing theirs. So even when times when you ask them, for example, to go and support another branch, they feel a little bad because they know that that is taking a lot of their time, which time they would be able to deploy on their own branch. Okay, so that that would be a big factor. And then the other is, of course, any good performance measure should also include factors which the managers can be held accountable, which is the element of controllable. Okay, it should be basically around something that managers can control, and then it should also be able to recognize the long-term objectives as well as the short-term objectives. Okay, just like the way we had about very similar to what we just had on the principles of these principles of performance measures. Okay, now to proceed in the same way, these are just basically to give you more about the cost center. Of course, like we say, the cost center is where you're in charge of costs. Okay, and where we try to look at the performance measure on costs is the standard costing variance. Okay, so I've already tried to explain that with you to determine. Okay, now we have a summary here of how controllable profit is. Remember, we said when it comes to profit centers, we try to look at the controllable profit. Okay, so we have sales, we have external and internal. As you can see right there, we have controllable. Then after our sales, we have the controllable divisional variable costs. We have the controllable divisional fixed cost. Whenever you see the word controllable, it means that the manager of this division has control over it. Okay, so that's what we're getting. So, and then they are giving us what we are regarding as our controllable divisional profit. The controllable divisional profit is the profit, that one I've highlighted is the profit that we shall evaluate the manager on. Okay, now after looking at the controllable divisional profit, we also have what we're calling what we call the traceable divisional profit. Now the traceable divisional profit is used to evaluate the performance of divisions. okay, is used to evaluate the performance of divisions. And when it comes to a controllable divisional profit, in determining the traceable divisional profit, basically what we do is we go ahead to less again other traceable divisional variable costs. So like here we're trying to less more other costs. In most cases, these other traceable divisional variable costs, we had left them out because they were not in the control of who? Of the manager, of that respective manager. Okay, that is why we first list them here as well in addition. In the same way, we also go ahead to list what we are regarding to as other traceable divisional fixed costs. Okay, and this could also be divisional fixed costs that we had left out up, and then we are now listing them here to get what we are regarding to as our traceable divisional profit. Okay, right there. Now, just to give you an example of a traceable divisional cost. Now, you may find that we have, let's say, maybe a Lower branch, Kampala branch, and then maybe Gulu branch. Okay. Now, when we are trying to look at, we could have a cost. For example, this cost might be for repair and maintenance of, let's say, the office of let's say maybe branch Alua. Okay, the repair and maintenance of branch Alua, and we might have done this. This decision might have come from head office to say that this branch needs to be repaired, doesn't look good, doesn't give us a reputation. So the CEO makes a decision and says we should go ahead to repair this office. Okay, maybe painting and branding and so on. Now, this cost in itself, the manager of the branch doesn't have control over it because this is all coming from the head office. Okay, so as this is not a controllable divisional, let's say, cost, it is a traceable divisional cost because it's a cost for the division. Okay, it's a cost for the division. So it's important for you to understand those concepts. Another could be, let's say, they could be let's be an audit cost. Okay, maybe we have auditors that are auditing a given branch. Now that the cost of auditor, it's a cost that can be traced to the branch, but the branch manager is not the one who hires these auditors. Okay, these are basically hired by the head office. So as it is a traceable cost to the division, it is not a cost that is controlled by the manager. So when we're evaluating the manager, that is why we use the controllable divisional profit, where we're only looking at the controllable revenues, and then we're also looking at the controllable costs. But then when we want to evaluate the performance of a division, we shall now use what we call the traceable. And like we are saying, when it comes to the traceable divisional profits, we are trying to include any additional costs, both variable and fixed, that are traceable to the division. Okay, so that is important for us to understand. And then, of course, we have this last part, which is called the apportioned head office cost. The apportioned head office cost. And with the apportioned head office cost, this is usually a cost that the head office just apportions, maybe based on different parameters. Like I gave you an example, it could be the salary of the CEO of the overall company. Okay, and since the head office does not make any sale, the different branches are the ones that pay for the salary of this CEO. So they may apportion 10% cost on each of the branches to relate to the salary of the CEO, okay, which is the apportioned head office cost. So that is one element of when it comes to evaluating a profit center, okay? So, and then we're able to get our net profit. So what we are also saying here is that, of course, one of the challenges that we get when it comes to controllable is traceable is of course there's some element of judgment that we basically have to make right there, okay? And then also being able to understand what the manager has control over and what is traceable to the division. Sometimes, of course, we might have some challenges in making such kind of judgments, okay? Yeah, but that should be able to give us what exactly we should basically do. So that is how we evaluate a manager and a division under the profit center, okay? Now, under the investment center, remember the investment center, these are usually, these are divisions that are allowed to do what? To, let's say, purchase fixed assets, okay? These are, they are allowed to purchase fixed assets, but okay, in general, they're allowed to make investments, okay? They're allowed to make investments. And this is where these two terms come in, the two evaluation measures, what we are regarding to as the return on investment, okay? What we regard to as return on investment, and then the residual income, the return on investment and residual income. And what we are saying that return on investment is basically a calculation of the controllable, traceable profit, which we just saw up when it came to calculation of under the profit center. This controllable, the controllable divisional profit, okay? The controllable divisional or the traceable profit down there, divided by the controllable or traceable investment. Now, depending on whom we are evaluating, if we are evaluating the manager on ROI, we now use controllable. If we are evaluating the overall division, we now use the traceable, okay? So that's why we've done controllable in bracket traceable, and the same thing also which comes to this. So return on investment is basically profit over the investment, okay? Profit over the investment. And then the other is the residual income, okay? The other is the residual income. Residual income is one of those other measures that we use to evaluate investment centers or those divisions that have the autonomy to make investments. And with the residual income, we basically get the controllable or traceable profit, depending on whom we are evaluating, and we less what we are regarding to as unimputed interest charge. We less what we are regarding to as unimputed interest charge on controllable or traceable investment, okay? So that is what we do with, yeah, I know you know interest. Interest basically, interest is a charge on capital, okay? So that is what we basically do there. Of course, we have basically there are different reasons why different organizations may choose either to use the residual investment, return on investment, sorry, or the residual income as measures of determining the performance, okay? Of determining the performance. So we are going to look at one example of this for us to be able to determine the problems within both of them as well as that, okay? So we have an example here. We have an example here, but for matters of this class, I think since it's already 21:32, I'll end this class here so that next time we can actually basically start from this calculation, okay? We can basically start from this calculation to determine, and then we can try to understand how each of these play, okay? So I'm going to share these notes with you so that during the week you can basically go through, so that when we meet next time, we can basically just start from where we stopped and try to understand the other elements of this topic, okay? So yeah, Henry says, as you joined late, I'm going to share the recording just shortly. I hope it actually recorded. I'm going to share this accordingly so you can get it. All right, thank you so much, and wish you the best.